quick warm welcome from me, David Illich. I'm the deals leader at PwC, and welcome to all those on the line. We're we're delighted to have you all here, and the guys have pulled together a pretty esteemed panel for the next 45 minutes or so, and then to have some Q&A. For my sins, I'm not a CFA charter holder. I'm a CA, but if I had my time again, I certainly know which way I would have headed. I think back in 2004, when I started my career, only the real smart guys were doing it, and I wasn't one of those. And I sort of followed the more traditional CA approach, but certainly at PwC and the deals team, the split has completely changed. It must be 80-20 now, and particularly the broad skill set that we're looking for, and ultimately the opportunities that CFA provides to its charter holders is pretty astounding, with the global recognition and just to be honest, the skill base increase. And we really reap the benefit of that as they're going through, albeit you do have some pretty hefty study requirements. Which is very impressive. So I'll get out of the way, but please make the most of the food. Otherwise, I will take it down to my team and they'll be on it like seagulls. But just do a quick bit of intros just for the panel. We've got Erin, we've got Hamish Ellis-Jack, we've got John. I'm not going to pronounce his surname, Annabelle, who's going to act as mediator. And I'm going to infiltrate and sit in on this because I'm actually quite interested in what they've got to say around unlocking the power of alternatives. And for my sins, I do a lot of work in the private capital space, private equity. And so really interested to hear some of the themes coming through today. And also, to be honest, some different views, because I do live in a bit of a glass box, and be good to hear some different perspectives, particularly from different age ranges. So I'll get out of your way, and thank you very much.
Kia ora koutou. First, I just want to clarify, I'm going to facilitate, mediate. I'm not, I like a robust conversation, but I don't think there should be any contention here. So I am from Invest New Zealand. I head up the AIP team that is in charge of the growth category products, and we try and attract high net worths with amazing capability and backgrounds to come and live in New Zealand. And so I'm very familiar with John and Erin and the world they live in, and keen to get into having them tell us a bit more about what they offer, and then also over to Hamish. So perhaps I thought we'd be best if we introduce all the panelists a bit more fully, what sector you're in, what you do day to day, and how the asset class you're involved in has evolved in New Zealand over the last sort of 5 or 10 years. So perhaps I hand over to you, Erin, and then we'll just go along the table to Hamish and then John.
Capital Group, funds. Private credit is a part of the AOP program, but also just an up-and-coming industry in New Zealand in the alternative scene. Private credit is, we are lending to direct senior secured loans to established New Zealand businesses, focusing on cash flow positive businesses and growth companies within the New Zealand economy. We do floating rate loans. We are focused on capital preservation and consistent returns for investors. So it's a relatively conservative strategy within this asset class, and it's proved really popular with migrants coming in through that AIP program as well. Private credit's relatively new to New Zealand, probably less than 10 years old. Really kicked off after 2019, where the capital rules around the banks went through a massive shift. I'm sure you all know about that. It really changed the corporate lending space, and there's been a few private credit funds since then making the most of that opportunity to get into that.
Hi, I'm Hamish Ellis-Jack. I am the Chief Financial Officer for Sustainable Property Investment Fund. I'm also a director of the CFA New Zealand Society, so here in a bit of both capacities for both. So we are a wholesale-only commercial real estate fund. We have properties all across New Zealand, and we have a diversified portfolio of commercial properties, industrial, office, and retail. We find that diversification gives a great risk profile to our investors. Property, as I'm sure most people are aware, is a very well-established asset class within New Zealand, potentially too established. depending on who you talk to. So it's very much a legacy asset class. Our fund, for example, has been around for about 17 years. And while there have been some changes in structures, limited partnerships, I think, are becoming less optimal for a lot of investors. Property certainly has been around for a long time. And despite any potential capital gains tax, I can't see it disappearing as an asset class anytime soon.
Hi everyone, my name is John Cowles, co-managing partner of New Zealand venture capital firm, GD1. And as venture capitalists, we invest in early stage New Zealand tech companies that are going global from day one and seeking to win in the world's largest offshore markets. So we're not looking for regional champions. They need to be looking at the largest markets in the world. So early stage tech companies, so pre-rev right up to around $2 to $3 million in annual revenue. And then we help them to grow from there. We're also generalist investors, so we invest across 5 broad verticals. So software as a service, deep technology. Deep technology is innovation that's anchored by scientific expertise or advanced engineering. So typically innovation that's very difficult to replicate. You need deep domain expertise. Health technology, connected hardware, and also marketplaces. And then I'd have to say over the last 5 to 10 years, we've seen a step change in the quality, the average quality of companies, founders, and also the volume of deals coming through. And there are so many different reasons for that, but it feels as though we're going through somewhat of a golden era in the local tech ecosystem. I'll just give you 3 examples of why the New Zealand tech ecosystem is starting to thrive. First of all, very small country, but very diverse. So 5.3 million people, over 25% of us actually weren't born in New Zealand. So there's a lot of backgrounds, experiences, creative problem-solving styles, and that really does lend into the diversity and the creativity of the local tech ecosystem. And we've seen this coming out of the US, a lot of the tech companies out of there formed by fairly recent immigrants, and that we're starting to see that trend happening here too. Equally, we've seen abundance of technical talent come through our knowledge centers, so universities, power electronics, mechatronics engineering, computer science, bioengineering, aerospace. There's a lot of technical talent coming through. So New Zealand has one of the highest densities of engineering talent per capita globally, and so that's something we should be really proud of. And lastly, we've got so many foundational success stories already. And there are many obvious ones: Rocket Lab, Zero, Powerboat Proxy, wireless charging for the iPhone, founded by a New Zealander. And all of this kind of like gives today's founders and entrepreneurs real belief that global success can be made in New Zealand. So yeah.
Thanks, John. And sort of tailing off that, with that super early innovative stage, how do you price in or approach risk to that, and how do you mitigate it? And I'll throw it to you guys as well, but given like very different asset classes, very different ways of looking at pricing, perhaps, and everyone's got a view as to which is a riskier product, but ultimately, how do you look at that from an early stage VC point of view?
Yeah, that's a really good question. So within venture capital, we're at the end of the risk curve in terms of the higher risk. We, as I mentioned before, we're generalists, so we want to build a diversified portfolio of 25 to 35 companies. We invest in 6 to 9 companies each and every year, but we look at 400 to 500 companies each and every year to invest in those like 5 to 9 companies. So we have to be really selective. But by nature, venture capital is actually very high risk. And it means that traditionally, say, if you've got a portfolio fund, you'd expect around 40% of your companies to probably generate irrevocable capital loss, because we're talking about early stage tech companies. There's numerous ways of which tech companies could underperform. And then 40% of companies would probably generate around 1 to 3 times capital investment. And the top 20% traditionally are the ones that really generate the drivers of the returns of the fund. So small portion of companies driving the overall performance. The way we mitigate that is to be highly selective. We're generous as well, so we can select the best companies that we think are coming through across those 5 broad verticals. And we work with our founders throughout the journey as well. So we've got experts that help with commercialization, international commercialization, networks that we can plug them into. There's so many different ways in which we can help them mitigate those kind of risks along the way. Yeah.
And what about you, Hamish? Obviously a more mature industry, and I imagine there's more quantitative factors that you utilize for when you're pricing in projects. Could you talk to us a bit more about how you assess risk and how you price it into any of your modelling that you undertake?
Yeah, absolutely. I guess there's kind of different risk profiles within property. So overall, I wouldn't call property, it's probably more a moderate risk, but it's got a longer distribution of lower risk property transactions to higher risk property transactions. At the lower end, you've got long-term leases, stable tenants, institutions like ACC who directly own these properties. They call those basically government bonds. Strong tenant, low maintenance, and they basically buy property to proxy as an inflation hedge and to be like a government bond. At the other end, you've got development, which depending on your leverage can be highly risky. So we don't really play in development space. We're not developers for tax purposes or for our business strategy, but we kind of sit a little bit more in the middle as what we call a value add fund. So we are prepared to take some risk of looking at buildings and opportunities where there is the opportunity to buy a building that may need some improvement, need some capex, maybe poorly or not leased properly. And so the risk in that is that you're buying a building that may have low to no income and may need a couple of $1 million of capital upgrades. So that's the kind of the risk profile that we kind of factor in. And we run the way that we value that and assess projects is NPV, IRR, so nothing too out of the ordinary, but it's making sure that we're getting compensated for that risk to our investors, the downtime of not having cash flow, because in our property portfolio, the cash return is very important to our investors. So it's taking balanced risk and also having a portfolio that overall has a low to moderate risk profile. So in our current portfolio of 15 properties, we've got one that we have been going through a value add cycle with about 6 million of capital spend slowly being leased up. And then another site that is a development opportunity, which at the moment we've just basically closed the doors and we're looking at development opportunities. So in a portfolio of say 200 million, 15 properties, we've got about 25 million of that in a kind of riskier bucket for development and for value add improvement. But the rest of the portfolio has grown very, very well over the years with that same model. So for us, it's a proven model and it's just balancing the risk so that we're not overly exposed, especially the last couple of years with high interest rates, property market downturn. If we had a whole portfolio of risky value-added development projects, then things might have been very, very tough for us and the banks would not have been happy.
And you touched on it slightly, but can you expand a little bit more on what does diversification look like within a property fund?
Yes, so we diversify across geography. So we have properties in Whangarei, North Auckland, South Auckland, not CBD, but Southern Corridor, we call it, around Ellerslie and Great South Road. We also have properties in Christchurch. So we're getting exposure to different markets in terms of population and demographic growth. We try and manage weather risk, which is why, and earthquake risk, which is why we take calculated risks. Our property is in Rolleston, not in Christchurch Central, and we generally stay out of Wellington. And then across the property types, so your key commercial property types are office, industrial, and retail. And we have a mix of those three classes across our fund. So we get diversification of location and also property type. So last couple of years, office has really taken a hit. It's been really tough and it still is quite tough, whereas industrial has performed really, really well. So our industrial assets have offset some of the losses that we've had from the office sector.
Thanks. And Erin, what about private credit? How do you guys assess or look at risk from a private credit lens?
So almost the opposite to John. We're not looking for one standout performer. We're looking for consistency and stability across our whole book of loans, how we think about that. So there's a lot of due diligence. It's all risk assessment, ability to pay it back. Yes, we're looking at cash flow positive businesses, things that are generating these are solid SMEs, right? It's not as super sexy as sort of big tech cool stuff that VC does, but these are great businesses, the backbone of the New Zealand economy, and there's a lot of work that goes into it. One of our biggest risks is fraud, so we're doing a lot of work into who are the borrowers. One of the good things about the New Zealand economy, it's very relationship driven, so everybody knows everybody. There's few rocks you can hide under, but our team spends a lot of time diving into who the borrowers are, what their business is, and how they make their money and what their forecasts look like. We also try and avoid concentration risk. So in that way, similar to these guys, that we're trying to avoid any too much in one pocket of the economy. We're spread across all sorts of verticals, but we avoid things that tend to be very cyclical. So we avoid property. We don't have anything property related in our books. We avoid tourism by and large. We avoid hospitality, sticking with things that are generally consistent, stable industries. So our investors are looking for capital preservation and these solid returns, and that's always the focus. Yeah, I think that's something.
And remember, I'm facilitating, not mediating. So, can you? Yeah.
Plenty of people ready to invest in property.
Perhaps to give some illustrative examples might be helpful in terms of if you can speak to a couple of the companies you've currently got exposure to or previously did, and how hands-on or not are you like in there helping grow the company? Are you a strategic advisor? What does that look like? And perhaps Hamish, I'll start with you.
Okay, that's an interesting one for us. I guess the nature of being a commercial landlord is that we are ultimately there to support and help grow, people's business by providing them good premises, good rent terms and good commercial terms. And there is certainly a partnership element of that. And one thing that I think we do really well as a property manager is that we have great relationships with our tenants. We have very, very low default rates, and especially through COVID, we, came through that very, very well. And we have the flexibility a lot of the time because we have different properties, and especially in the Southern Corridor, we have 3 different office buildings. So sometimes tenants will come to us and they'll say, hey, look, we're growing, we need more space, or we're changing our hybrid remote working policy, we need less space. And many tenants just say, well, either too bad you're stuck into a 3-year lease, or too bad we don't have anything else. We try and actively work with our tenants to create spaces for them, to say, hey, look, at this building, we've got a bigger space, we've got a smaller space. So we've got a number of tenants, especially in that Southern Corridor, where we have lots of smaller tenants because we've got large office buildings, who have been with us for a long time across 3 or 4 different leased spaces. Sometimes we have put in intertenancy walls to subdivide a bigger space into smaller spaces because that's kind of where the demand is. So for us, we're not trying to fit the round peg into the square hole all the time. We're trying to work with our tenants because that longer term partnership, I think, is really important, because quite often your landlord can be just like a faceless person, almost like IRD, that people don't pay as a priority. But if they actually know us as humans and know that we're on their team and we want to keep them for the long term, I think that makes managing any challenges they're having in their business really good. And as a manager, I think it's a very good model, because we get happier tenants, we get much lower rate of default, and I think it's just a win-win for everyone.
So you put a high value on, I guess, relationships, and although you might have a legal contract saying this is what you must do, you're quite pragmatic when it comes to flexibility around that. Yeah,
absolutely. So it's very much relationship driven, and we see a lot of companies that have good properties, but I think where we add a lot of value is in the management and the leasing side, because that drives a lot of value from the property of unlocking that income from good tenants, stable income flows.
And how did that work during COVID? Were there any interesting examples of where that relationship side really came into play, and how did you work with people that suddenly went full remote?
So I joined the firm just after COVID, but really there was overall a good degree of flexibility of trying to kind of find the middle ground of rent relief, but also understanding the costs that we still have. Because while we can say to a business, okay, you're not getting revenue, don't pay the rent or reduce the rent, that doesn't always flow through to insurance and rates and all those kind of things. So again, a very pragmatic approach where we understood that we were kind of all in the same boat, and it was how can we work together to make sure that we all get through this, rather than just saying, you owe us this amount kind of thing. And again, it took a bit of a process, and there were a few that kind of did overhang to it when I joined the firm in 2023, but there was very much that partnership aspect, and we got through without major tenant loss and without major hits to our property portfolio and income streams.
And what about you, John? GD1 come in early when sometimes perhaps there's only one or two founders, you know, there's not these big corporate teams.
Mhm.
How do you approach, are you hands-on, or how do you approach your equity stakes with companies?
So how do we manage our companies and how do we look? Yeah, so first of all, we take minority positions, so 10 to 20%, because we need the founders to own the majority of the company, and it gives them motivations and incentives to really like build value on top of what they already have. We're hands-on investors, which basically means that when we meet each company, we get a good understanding about where their capabilities lie and where we can add value. I think the days are gone where financial investors with venture capital is, you know, the full stop. You really need to come in with value after the first check. So basically, there are numerous ways in which we can add value to our companies. For example, go-to-market strategy. So international commercialization is really important. Putting in the right place, the right hiring of people, marketing, sales, tech stack, processes. We have people internally that can help them with that. So people coming out of the US actually work for early stage tech companies, have a really good understanding about commercialization, and that's really important. Secondly, international connections. Our job is really to get them investment ready for the next round of financing. So building up their value to the point where international VCs may actually be really interested to take a look and invest in the companies that we invest in. So our global connectivity is pretty good. So international VCs, these are the kind of people that we will open up the doors to, because they'll have deeper pockets and access to offshore target customer markets that could be really beneficial for our companies. So that's really important. We also have connectivity to loads of people that could potentially work for our companies. Hiring is really important. Financial review, financial analysis. There are numerous ways in which we can help our companies. I speak to my founders probably at least once a week, because it is so important that they are supported through the process, because they're under so much pressure and they have a fiduciary duty with the investment that we make into their company.
Yeah, so again, I guess relationship driven
100%.
and taking a smaller stake on the cap table enables them to be quite attractive from an offshore perspective
Yeah.
when they grow.
Yeah, and we sit on the boards of a lot of our companies. We help with strategic value, strategic direction, so it's pretty important.
Yeah, interesting. What about private credit? Imagine relationship led again, I assume, or how do you approach things?
It's a theme, and we think of ourselves in that process as active credit owners, but not operators. We're not there to tell these people how to run businesses. We're invited to lend to them because we can see they're experts in that themselves. We do maintain very close ties, so these regular management meetings, whether we're able to join board meetings or a very similar format, we get board level reporting from all the companies we lend to. There's covenant monitoring, early warning analytics. The investment team remain very close to business numbers as the loans mature, and we're able to engage early if we start to see that performance or abilities to repay are drifting. Again, we're focused on capital protection at all times. So the relationship is really important. There's a lot of honesty and transparency required, but there's also legal systems in there to help us make sure that continues to happen. But yeah, we think about the industry to us originally about that. So most of our deals aren't public, but we one of them recently was carbon group, so it's electric vehicles fleet management system across New Zealand. It was one of the only ones we've been able to do any press around, which was exciting for us. But we've got things across aviation, manufacturing, and everything from really very specialized manufacturing, which New Zealand does a lot of, through to more standard stuff, roofing type people. There's the data center, there's a media company, there's really a really interesting stream across industry.
I'm conscious of time. We've got some more questions, but I thought perhaps maybe see if there's any Q&A from online or from the floor. And then if not, I can go back to facilitating. Mediating. Yes.
Might be more for you, but I just think you've set this where it's like high risk spectrum to low risk. But I just wanted to
That was accidental.
That was wow.
Just wondered, like, for your international investors, especially on the AIP program and stuff, like, where they prefer to kind of sit.
Yeah, so at the moment, more traditional type real estate, if it's not infrastructure real estate, like student accommodation, for example, that sits in the balance category, which is not the category that Invest NZ have a monitor or pro. So venture capital and private credit are both receivers of AIP money in the growth category. Private credit is very popular. I think there's a number of reasons for it, and there's been a lot of discussion around it, and I think there's a couple of drivers. Obviously, the revised settings in April meant there's a heavier weighting towards money towards managed funds, and also the 3-year vesting period. So investors need to vest money for 3 years before they're eligible for a visa. That obviously nicely aligns with private credit. But in addition to that, I know the private credit funds in New Zealand have they've all got track record, and they have got it's more of a non globally, like private credit globally is very known and people very comfortable in that asset class, it seems, from discussions with AIP investors. So I think it's a bit of an and thing. It's not just because the settings have a 3-year, there's liquidity available there. It's that and the asset class is known and it's very popular globally. And then we are seeing some really good flows into venture capital. And what some of the sound bites I've had from the VC community is that the type of investors they've attracted into the funds are amazing. The strategic inputs they might be able to unlock, or just the alignment with what their kind of investment thesis is it's been very well matched. So although they might not be receiving the same amount of capital flows, there's definitely money flowing to and being committed to venture capital. And we one thing that will be really interesting is as the program grows, seeing what those investors, investors into GD1 now from the AIP program, we're really hopeful that they will unlock either, strategic partnerships or just extra capability, or, assuming performance only goes one way, that there'll just be follow-on investment into it as well. So it's a bit of an and conversation. I don't know if you want to add on anything, John and Erin, to that.
No, I think you answered it pretty well, to be honest. Yeah.
Absolutely. I think New Zealand's got a thriving, as John said, we've got so much innovation. We've got really innovative early stage.
Excuse me, Annabelle. Is it
yes.
possible to repeat the question so that people
Sorry.
online can hear?
Absolutely. So the question
Thank
was,
you.
is there enough product, I guess, in New Zealand to for AIP investors for their flows to go to? There's a mountain of capital coming from AIP. And I guess my answer is yes. We have got, I think at the moment, perhaps 52 approved managed funds on the platform. And obviously, depending on the asset class, some of them will close soon, some of them are evergreen. So we've got a good mix of products. There's more funds that we're talking to who are really interested in unlocking the opportunity. Private credit, Erin, perhaps you can speak to the, I know the private credit sector have a very bullish view on how much private credit can hold in New Zealand. As banks restrictions loosening, there's definitely a need for those steady growing companies in New Zealand to access capital with the terms that are approved. Maybe you want to speak to that.
Yeah.
A little.
I mean, when you look at the private credit market in New Zealand, it's so new and it's so young. And if we look at our total addressable market, corporate lending in New Zealand is currently around $80 billion. Private credit is less than 2% of that. And if you look at international markets, which comparatively have a much longer track record with the private credit ecosystem, so US and Europe, in the US, almost 80% of corporate lending is private credit. So when you look at that, there's so much opportunity and room for growth in our space here. And I was talking to these guys before we started, some feedback we got this morning from a borrower who's about to move ahead with us after months of extended conversations with the banks, and just from their side, a lack of flexibility and the inability to negotiate based around what's better for their business rather than what's better for the bank. That's what's as borrowers and the rest of the market, you know, you guys will be helpful in that, learn more about private credit and who it's good for and what it can be used for. There's more and more uptick of this. We're seeing a lot of growth. So there's really a lot of room for potential. Like we're seeing hundreds of deals a year, and we're super picky. So we're hoping to have 20 loans on our books by the end of the year. But this next year will be even bigger. There's so much potential. We're not worried about that at all.
John, what about you from an early stage sort of ecosystem point of view?
Yeah, I think just to put into context, like over the last 3 years, the New Zealand VC ecosystem has taken on a little bit over $1 billion of investment capital to invest in the local tech ecosystem. And that actually isn't enough to satisfy the amount of deal flow that is coming through. But also just to put it into context, the previous 15 years before that, the VC ecosystem only took on about 300 million. So we are catching up, and I think on a per capita basis compared to other more mature tech ecosystems, we can definitely absorb more. There are, tech verticals that are more capital intensive, like connected hardware, deep tech, space tech in particular. But a number of companies we're seeing each and every day that are seeking like capital, it's just phenomenal. And like if we don't increase the amount of capital that's going into VC, these companies will ultimately be lost to offshore investors, and that's ultimately what we want to avoid.
Yeah. And perhaps I know you're not quite in the growth category yet, Hamish, but perhaps what do you have a view in terms of the infrastructure of various types is permitted in growth? Do you think New Zealand has a big enough market and need for infrastructure build?
Yeah, look, I definitely think there is, and that's I think something the government have really identified. The need for more privately funded infrastructure assets. And you're seeing, I've been to a few kind of investment presentations this year, and infrastructure globally is one of the top performing asset classes, performing very strongly. So when capital goes where the returns are, and I think more people want to invest in infrastructure. And if we can open ourselves up to create more public-private partnerships in that infrastructure space, I think ultimately that's better for the country. And I think having better infrastructure then leads to a better overall economic and social environment. That means more people want to live here, more people want to invest here. So it's infrastructure. It's called infrastructure for a reason, and it kind of is the foundation of everything else that we've been trying to do. And there was a article about the new proposed State Highway 1 through to Whangarei, and something like that, a good, reliable roading project, then means that trade coming in from the port and oil refined at Marsden Point, all those things become easier, less cost, more profitable, and that attracts more capital in. So I think a focus on infrastructure is very important. And I think the challenge will just be getting runs on the board for outside investors to see that it is possible, that it can be done with the government here in New Zealand, and that there are the investment returns that you see in other parts of the world as well. I think capital should hopefully flow into those infrastructure projects in New Zealand.
Any questions online? Any other questions from the floor? Maybe we'll wrap up with one more question. Career pathways, not that we're trying to poach anyone or anything, but just interested to hear from all of you on within your sector, perhaps a quick sort of how you got there and what you're seeing is how, the career opportunities now for people, especially like given the rise of VC and private credit, and how do you get into where you're landed? John, do you want to?
Yeah. So my background lies mainly in finance. I spent 14 years in London, and what I really wanted to be was an investment banker or a hedge fund manager. I ended up working for a front office equity analyst for a very well-known hedge fund, GLG Partners, and ended up not liking it. So I reached that pinnacle of like what I thought my career would be, and I wanted to get closer to the private markets, because when you're close to the private markets, you can be close to the founder journey, and you can help the ship move faster. So after 3 years of working as a front office equity analyst for a hedge fund in London, I moved to becoming an LP, so an investor in VC and private equity. So I managed the alternatives program and actually built it out for Tesco Pension Investment. Tesco's the second or third largest supermarket chain in the world. So from $0 to building it to 1.5 billion British pounds, just created the program around alternative investment and spent 8 years traveling around the globe, just meeting with best-in-class VC, PE managers, and just kind of getting a good understanding about how they operate, how they find deals, how they add value, and how they ultimately exit as well. So the full life cycle of a venture capital fund. But the real important thing for that is it built up my Rolodex. So now again, for our companies, those are the kind of doors that I'll open up to. I did a lot of angel stage investing as well, but also became a founder when I eventually came back to New Zealand after 14 years in London. So I do have that kind of entrepreneurial spirit. I understand, have a lot of empathy for how hard it is. But I've been with GD1 after founding my own company for the last 9 years, co-managing partner for the last 5. Just quickly, my co-managing partner, very different, engineering based, worked for Fisher & Paykel Healthcare, designing devices for helps resuscitate premature babies, went and did his Wharton MBA at the University of Penn, and then worked for Apple, like acquiring new nascent technology and then scaling it up within the Apple framework. He is also a founder as well in the oncology space, and ultimately have very differentiated skill set to what we do. VC firms are quite small, so if you want to work for a VC fund, you actually need a differentiated skill set and background experience. You need to be additive to what we already have, because it's so important. You can't add the same thing as everybody else. In New Zealand, the VC ecosystem has taken off. There's more VC firms, but I'd say to get into VC, because there aren't too many roles that have been offered, considering the size of the VC, you need to show that you've got a passion for tech, passion for investing. You need to network your butt off, like go to all the conferences, meet the GPs of all the venture capital firms, build up your own network and understanding, even invest your own money if you can, lose some money, because that is a really good way of kind of getting a good understanding about what you won't do in the future. So you become less bad. But so basically networking, aptitude, understanding, and also you got to have a good understanding about it's not a 9-to-5 job. Like you need to kind of be really dedicated to VC, and you need to help your founders out as much as possible. That's not a 9-to-5 job. So I think networks and just building relationships with local venture capital managers is definitely the way to go.
So my background is corporate finance, investment advisory. Started off life with PwC, then Deloitte, Foodstuff, Spark. Went over to the UK, did that for a couple of years and did contracting over there, and then kind of came back post-COVID, and I was offered this role in property. And so for me, it was about property as an asset class from an investment perspective rather than ever having kind of worked in property. But I guess the thing with property is that it's pretty tangible, and everyone kind of understands it on some level. You know what a building is, and we all live in a home, some form kind of thing. So it's been really good. We're a small, I mean, there's only 4 of us, so essentially 2 finance and 2 property focused people. Having done a lot of transaction work, a lot of advisory work, where you kind of ring fence an engagement, and you might come in and work for on a deal or a company for 6 weeks, 3 months. The longevity and the longer term focus has been really, really rewarding, and having that longer term view, having a consistent base of investors and stakeholders, it's been quite cool to actually be in one place for more than a very short period of time. And when you're actually developing strategy and doing deals, you're actually there on the other side, and then some of implementation as well. So how I got into property was, say, probably a bit different, and came to it with a skill set applied to an asset class. I mean, jobs in property these days, when I was at university, there was a pretty new Bachelor of Property. So property and kind of what it encompasses in New Zealand has grown a lot. And I think the technical side has improved a lot, which is good for the industry. If you want to get into property investment, there is a big range, there's quite a diverse range of companies, developers, fund managers like us. There's also all the real estate agents, though most people in this room probably don't necessarily, that's maybe not their skill set, maybe want more of a technical approach. So there is a property as an asset class, and like with any asset class, there are analysts, there is a listed sector, there is a private sector. So like any analyst class, there are any asset class, there are different opportunities to get involved in the sector depending on how hands-on or otherwise you want to be.
So both you're not a linear or traditional pathway to where you've got to,
No.
which I think is probably quite aligned to you, Erin. Talk us through how you got to where you are.
Extreme non-linear version. Yeah, so not a finance person. I've been offshore for the last 20 years, most in UK and Germany, 13 of which I was working for Grueber in Germany, leading the programs that we run there for startups. So I've kind of always been at this intersection between founders of companies and investors and the rest of happening.
Battery died on my laptop. Sorry.
Technical difficulty.
Thanks. Always been at the intersection of people solving the problems rather than the numbers behind it, and that's kind of where my heart continues to lie. I'm in an investor relations role right now. You will have guessed I'm the number cruncher at Private Capital Group. Thank all the God. So yeah, so my career path has been very different to probably all of yours in the room. Private credit is new for me. What I think consistent for me across this very non-linear path, I'm very curious, relationship driven. I like to get to know everybody. When I landed back in New Zealand a couple of years ago, I joined FZTE, which is now Invest New Zealand, and was running the program with investor migrants and the investment ecosystem, which is how I got to know John and all the VC people. But this was an incredible opportunity for me. It was such a great landing pad, getting to know all the interesting people around the whole country. And now I've ended up at a fund, which many of my university professors will be rolling in their graves thinking about. It's not, this isn't what I would have thought my natural habitat would be. Skills that I've built over time. Obviously, private credit for most people is very technical. It's very analytical, risk management. I guess most of the people, the guys, everyone else on my team are bankers and have been doing private credit and risk assessment for many, many years. So there's about all of their parts, but I'm the anomaly. It's fun for sure. We're a team of 6, and everyone else are the bankers and the relationship.
It's that additionality that John was talking about, I guess.
Yeah. Some of the guys in my team don't want to leave their screens. They're happy behind the desks and doing the numbers in the spreadsheets, and it's a good division of labour. So yeah, I leave them to that, and they leave me for my bit.
Well, because I'm a stickler for time, I think we will wrap up. Thanks everyone. Thanks panel. Super interesting. If you've got follow-up questions with these 3, go for it. But nice to see you. Thank you everyone online.
Thank you. Bye.
My duty.